Well, welcome to the week of January 19th, 2025. And this is our weekly update. And the things that we're watching this week has a playback from last week. And the past week was a great week for us. It was a really encouraging start to the year. So let me jump right in because last week we really spent a lot of time discussing the interest rate market. And when we talk about interest rates, what we're talking about is the 10-year treasury because that's what everybody bases the interest rate market off of. And last week we shared with you that in January we started the year with the 10-year being right around 4.76%. And for quite a while, for a good year or so, we've been hypothesizing that we're in this Goldilocks part of the economy and Goldilocks part of the interest rate market, where ideally, if the economy can just stay where it is, not too hot, not too cold, and the 10-year treasury can stay below 5%, preferably between 3.5% and 4.5%. If you can keep that kind of range, and you can see we've been in that range now since really the start of 2023. So if we can get another year of this, then all the interest rate sensitive investments, which if you're an income investor, you really need to have. So the things like utilities, traded real estate trusts, even energy stocks, if we can get another year of the 10-year trading between these 2 points, then those holdings could be some really impressive holdings, and the relative strength could keep building on them like we've been seeing over the last couple months. So this is really, really crucial. We needed to see this week the 10-year stop pressing higher. The last thing we wanted to see is it to get above 5% and stay above 5%. So what's happened since our last video is in this past week, we did get a little bit of a pullback or reprieve in the 10-year. You can see here we've pulled back from that 4.76. Ended the year, right? Ended last week right around 4.6%. So this week, it's really, really crucial to see rates stay below that last high. We call these, I'll show you here, we call these little pivots. So we really want to see rates, so the 10-year stay below that last pivot. If that continues and we start to break below this little area of support, that 4.5 level, maybe we can head down to 4.25. In order for that stuff to happen, the economic reports over the next few weeks are going to have to show some weakness in inflation. And recently we haven't been getting a lot of that. And with the rise in oil prices, we've got to be really hesitant about assuming rates will go down too low too fast. However, let's watch it because the next tell is what do we do here around 4.5%? Honestly, I think if we can get below 4.5%, then a lot of the markets that we're watching can hold together and keep rallying like we've seen. So last week, what I was really watching in the traded real estate space, because this is something we do have in our portfolios, is EPR properties. And I talked about how important it was to see interest rates, the 10-year pull back a little bit. And we really wanted to see EPR properties and the traded REITs hold these last pivot lows that they had. So for EPR, it was around $44. What's happened since then? Last week was a good confidence builder in the traded REIT space. You can see that we sprungboard off of that 44 level, have gotten squeezed higher. We're not out of the woods yet. However, this is very encouraging if you're an income seeker and you want things like traded REITs in the portfolio. The fact that the 10-year is pulled back and a lot of the traded REITs have held these lower pivot points from a week or two ago is a great thing. Another example of that is we shared with you Annaly Capital, a mortgage REIT, a high yield mortgage REIT. We wanted to see it hold that 18 level, and because if it can, maybe it can rally up towards 20 while paying some good dividends. Last week, that Annaly held exactly where it needed to. It pivoted higher. another confidence builder. So now what's we want to watch is it getting magnetized? Is it like a magnet? Is it getting pulled towards that 20 level? And if so, if and when it reaches there, how does it behave and what's going on in the 10-year? So all encouraging signs last week across the board for all types of investors. Another thing that was very encouraging, but I think could be concerning long term, is the prices of oil. We shared this long-term chart in our newsletters for the last couple of years, how basically oil prices have been consolidating in this triangle or bullish kind of pattern. Typically, when these patterns resolve themselves, they resolve in the direction that they started. So we were assuming it would be higher. Last week, we started to break out of that resistance that had been holding back oil prices, and they've squeezed quickly up into that $84 to $85 price range. This is great for our portfolios because we've had exposure to oil and energy, and quite honestly, we were disappointed with it for a few months. So now it seems to be shaping up and getting into action. Now, what we really want to see here is we'd like to see a little bit of a consolidation in prices. We don't want this to keep going straight to the moon. So we'd prefer to see, over the next week or two, kind of go through just another little bearish or bullish flag type of pattern before going higher. This is not great for inflation, folks, and it's not great for the long term. But for us that have exposure to energy and oil, it's something that we've been waiting for a while. So it's a bit bittersweet. We also showed to you the energy sector over a long period of time, a couple of years. We did, with oil prices rising, it did exactly what you would expect. The energy sector pivoted off of long-term support. It's pretty picture perfect. It's now getting into some areas of resistance. So the next week or two, it's going to take a little bit of patience. It's important for us to watch this because if we cut through this like a hot knife through butter, then the energy sector of our portfolio should be beneficial or accretive. Again, something we've been waiting because we've been building a position in here throughout 2024. And it wasn't performing, and now it is. So that's really, really encouraging for us, at least. If you're not in the energy sector, you're not owning oil, keep it on your radar. If you need ideas of how to get involved or to want to find out if it's worth your time or if your risk parameters match, contact us. We'll help you go through that analysis. Another big topic of conversation before we get into the stock market is the price of gold. So we showed you this longer term chart of how gold has just been perfectly stair-stepping higher. We were asking if this recent consolidation the last couple months in gold and silver prices, is it just a sideways move or does it go lower, deeper retrenchment? We've pretty much gotten our answer because it looks like this move in gold has been sideways. We're now just bumping up against some resistance. It might take a week or two to get above this, but ideally, we'd like to see this kind of compress and break out. May not happen next week, but it definitely looks like something here in the first quarter. Metal prices could go through a run, and like we've been saying, we're late enough in this stage that if we do get a squeeze higher, it could be a really significant squeeze that could be a pretty hefty parabolic move, and not something that you want to chase, but something you want to be involved in early. So then that way, if it does happen, you can sell into the strength. So again, gold, silver, metal prices are important to our portfolios if you're a Quiver client, because we have a good amount of exposure to it. So we do want to see this squeeze higher. But for us, it'll be, again, bittersweet in the sense of we'll be happy that it's squeezing higher, but we'll be having to look for a place to take our profits. So last piece of subject matter that we're going to talk about is the stock market, because boy, was it a tricky one this week. We shared with you last week that, a word of caution, keep in mind that the stock market, the last time it had a really solid reset, was the Great Recession, 2008, 2009. So I'm showing you a chart from that time frame. You can see there's a pretty distinctive wave pattern of 5 waves. Typically, when you get to the end of a 5th wave, we want to start looking for our exit ramp, because then you could go through a 3-wave period. In this particular period of time, it could be a year, year and a half, where you go through a market correction. And maybe it's just a sideways correction. Maybe it's a deeper retrenchment that takes you down towards 5,000 or even 4,000. I don't know. But because we're so long in the tooth in the equity rally, it would be irresponsible of me not to, give words of caution that if you're a new investor to the equity market, tread lightly, start small, because you are entering in when the water is pretty deep. And so what we were looking at this week is that if the market was going to break down and go through a bigger correction, the big level for us was this 5,800 level. So this was our chart we showed you last week, and we said below 5,800, and you could see a deeper retrenchment down to 5,200. Not a huge decline, but something that would be notable. And above 58.75, the bulls still have the ball, and this rally could continue. So what happened this past week? Well, the market was really, really cool. I mean, it was like having a bad date with a bipolar and too many glasses of wine, because on Monday, the market did a little breakdown. You can see here this little head fake where we broke down below that 5,800 level, probably got a lot of people bearish, and then boom, by Tuesday, broke back above, and by Friday, the market really proved that, you got to wait to bet against things, because this breakdown wasn't enough of a breakdown to say that we should anticipate a correction. So going into this week, what I'm watching is do we build on this bounce, or do we come back down into this zone? That would be not great. But right now, the bulls have the ball. No need to bet against the market. It'd probably be unwise, because right now the path of least resistance is either sideways or upward. So for stock market investors, just sit tight, because we still don't have a resolution of whether the longer term pattern over the next 6 months is higher or sideways. But I do think we get that answer by the end of January. So stay tuned, folks. To wrap it all up, great signs in interest rates this week. We saw them pivot down where we needed to. Great signs for traded REITs, because they held their last pivot lows. It looks like they've bounced. That's a good sign of confidence. Oil and gold prices continue to look very robust and strong. Stock market continues to look a little confusing. However, nothing's really broken down to where it'd be a concern. So we're starting off the year with some really good positive signs. And if you have any questions, don't feel free to reach out to us. And until next week, folks, take care and enjoy the start of January.